Listen to me very carefully. Are you sitting down? Because if you are retired, or standing right on the doorstep of retirement, we need to have a real talk about your money. Let me ask you a question. Do you own a property, a rental house, or a portfolio of stock that you bought 20, 30, or 40 years ago for practically nothing, and today it's worth $1 million or more? On paper, you look wealthy. But every single time you think about selling that asset to turn it into income you can actually live on, terror strikes. You freeze up. Why? Because you are terrified of Uncle Sam. You look at the federal capital gains taxes, the state taxes, the net investment income tax, and you realize that if you sell, 30% or more of your life's hard work is going to evaporate straight into taxes. So what happens? You end up feeling trapped. You are sitting on a massive, highly appreciated asset that pays you very little cash flow, but you refuse to sell it because you refuse to hand over hundreds of thousands of dollars to the government. You lie awake at night asking yourself, how do I unlock this wealth to fund my retirement without getting destroyed by taxes? How do I guarantee an income stream I can never outlive? And what happens to my legacy? This is where people start whispering in your ear about a charitable remainder trust, or a CRT. And I want you to understand exactly how this financial tool works, the good, the bad, and the absolute truth, so you do not make a devastating mistake with your retirement security. A charitable remainder trust is an irrevocable trust designed for people who have two specific things: a highly appreciated asset and a genuine desire to support a charitable cause. Here is how the magic happens. Instead of selling that stock or real estate in your own name, you transfer ownership of that asset into the CRT. Because the trust is a tax-exempt entity, when the trustee sells that property or stock inside the trust, guess how much capital gains tax is owed at the moment of sale? 0. Zip. Nada. The full dollar amount from the sale stays inside the trust to be reinvested into a diversified portfolio. Think about what that means. If you sell $1 million asset on your own and lose $300,000 to taxes, you only have $700,000 left working for you. Inside a CRT, the entire $1 million stays intact, generating income for you. Then, the trust pays you, or you and your spouse, an annual income stream for the rest of your lives, or for a set period of up to 20 years. You can choose a fixed payout amount every single year, which is a charitable remainder annuity trust, CRAT, or a fixed percentage of the trust's value recalculated annually, which is a charitable remainder unit trust, CRUT. The IRS requires that payout to be at least 5% every year. On top of that income stream, in the year you fund the trust, you get an immediate partial income tax deduction based on what is expected to eventually go to charity. And when you pass away, whatever remains in the trust goes directly to the charity or charities of your choice. It sounds like a dream, right? You avoid immediate capital gains tax, you get a tax deduction today, you get an income stream for life, and you leave a magnificent charitable legacy. But hear me loud and clear. I want you to listen to the warning signs before you jump into this. First of all, a CRT is irrevocable. That means once you put your property or stock into that trust, it is no longer yours. You cannot wake up 5 years from now, change your mind, and pull that principal back out to buy a vacation home or hand a big lump sum to your children. That money is permanently out of your personal estate. If your primary goal in life is to leave every single dollar of your principal directly to your children or grandchildren, a standard CRT might make you furious down the road because the remainder goes to charity, not your heirs. Second, CRTs are complex and costly to set up and maintain. You need an estate attorney, a CPA, and ongoing legal tax filings. If your appreciated asset is worth $100,000 or $200,000, the setup and administrative fees will eat your tax savings alive. This tool is generally meant for assets worth $500,000, $1 million, or more. Third, you must set up the CRT before you sign a binding contract to sell your property or business. If you sign a purchase agreement first and then try to drop the asset into a trust, the IRS will look right at you and say, "Nice try. You owe full capital gains taxes." So what is your actionable takeaway today? Number 1, sit down and audit your assets. If you have highly appreciated stock or real estate that isn't producing income, calculate your tax basis versus its current market value. Number 2, ask yourself the honesty question. Do you care about charity? If philanthropy is already in your heart and you want guaranteed retirement income, a CRT can be life-changing. If you want your children to inherit that exact property, explore wealth replacement strategies like using trust distributions to buy life insurance for your heirs, or look into a standard revocable living trust instead. Number 3, do not do this alone. Contact a qualified estate planning attorney and a tax professional who specialize in charitable trusts. Get the math done on paper first. Protect yourself, protect your retirement, and make decisions out of clarity, not out of fear.